Welcome to Business with Louis, the show where we explore the latest concepts and strategies to help you succeed in the world of business. Today, we're going to dive into a fascinating topic that can make all the difference in your entrepreneurial journey: the psychology of financial decision-making under uncertainty. As entrepreneurs, we're constantly faced with uncertainty. Whether it's navigating market trends, managing risk, or making investment decisions, uncertainty is an inherent part of the business landscape. But what if I told you that there's a way to navigate this uncertainty and make more informed financial decisions? That's where the psychology of financial decision-making under uncertainty comes in. This concept refers to the study of how our thoughts, feelings, and biases influence our financial choices under uncertain conditions. It's a field that combines insights from psychology, economics, and finance to help us understand why we make certain decisions and how we can improve our decision-making process. One of the key principles of the psychology of financial decision-making under uncertainty is the concept of cognitive bias. Cognitive biases are systematic errors in thinking that affect our judgments and decisions. For example, confirmation bias is the tendency to seek out information that confirms our existing beliefs while ignoring contradictory evidence. Another common bias is anchoring bias, where we rely too heavily on the first piece of information we receive when making a decision. Influential thinkers like Daniel Kahneman and Amos Tversky have made significant contributions to our understanding of cognitive biases and their impact on financial decision-making. Their work has shown that these biases can lead to suboptimal decisions, such as overvaluing losses and undervaluing gains. So, how do these biases play out in real-world scenarios? Let's consider a few examples. Suppose you're an entrepreneur considering investing in a new project. You've done your research and gathered data on the potential returns, but you're still unsure about the outcome. If you're susceptible to confirmation bias, you might focus on the positive projections and overlook the potential risks. On the other hand, if you're aware of this bias, you can take steps to mitigate it by seeking out diverse perspectives and challenging your assumption. Another example is the story of Warren Buffett's investment in Coca-Cola during the 1980s. At the time, the stock market was experiencing a downturn, and many investors were hesitant to invest in the company. However, Buffett took a contrarian approach, recognizing that the fundamentals of the business remained strong despite the short-term volatility. Why? He invested heavily in Coca-Cola, and the rest is history. In addition to being aware of cognitive biases, there are several practical strategies you can use to improve your financial decision-making under uncertainty. One approach is to use probabilistic thinking, where you assign probabilities to different outcomes and estimate the potential returns. This can help you make more informed decisions by considering multiple scenarios and weighing the likelihood of each. Another strategy is to diversify your investments to minimize risk and maximize returns. By spreading your investments across different asset classes and industries, you can reduce your exposure to any one particular market or sector. Research has shown that these strategies can be highly effective in improving financial decision-making. For example, a study by the Journal of Finance found that investors who used probabilistic thinking to estimate potential outcomes were more likely to make informed decisions and achieve better returns. In conclusion, the psychology of financial decision-making under uncertainty is a critical concept that can help you navigate the complexities of the business world. By understanding how our thoughts, feelings, and biases influence our financial choices, you'll be better equipped to make informed decisions that drive growth and success. Remember, uncertainty is not something to be feared, but rather something to be managed with wisdom and foresight. As my colleagues on Wall Street often say, it's not about being right all the time. It's about being prepared for whatever comes next. So, take action today by applying the principles of the psychology of financial decision-making under uncertainty to your own business ventures. Use tools like scenario planning and decision trees to visualize potential outcomes and cultivate a long-term mindset that focuses on sustainable growth rather than short-term gain. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.